Hi everyone, hope you're all doing well, and today I'm going to talk about the free stocks that I'm buying. So I bought these free stocks last week and I'm going to spend a minute or two today talking about these stocks and why I'm buying them. As always, I have got full videos on these on the channel that are like 20 minutes long, so if you do want a bit more detail, go check them videos out. But I thought I'd share with you the free stocks that I've been buying recently, and like I said, just do a bit of an update on why I'm buying them, I guess, really. So yeah, hope the video is useful. If you do want to know when I am buying or selling these companies in real time, make sure you join the Patreon. I post when I'm buying or selling companies on there, and as well as that, I post at least 2 exclusive videos a week on the Patreon. And if you are a Patreon member, the new UK portfolio review for November has just gone up, and that UK portfolio is absolutely smashing it right now, so do go check that one out. And if you do want to start investing, there's some links to some brokers in the description like Stake and Free Trade. To join through there, you get a free share as well. But what we're going to do now is we're going to get stuck onto the free stocks that I'm buying. And number one, of course, it's Boohoo. It had to be Boohoo. So yeah, I've been buying a bit more Boohoo. It is starting to get towards my new UK biggest holding. S4 Capital is still up there, but Boohoo is only now just slightly behind it. You guys on the Patreon watching the video of the UK portfolio review, you'll be able to see how close it is now to S4 Capital. But yeah, my aim is to get Boohoo as my biggest UK position. It depends how much it stays down at this like £1.80 range. If it stays down here as a longer period of time as it can, I could build more shares and make it a bigger position, because I do think Boohoo at these sort of prices is absolutely bonkers, and the reason why it is down at these sort of prices is even more bonkers. So yeah, while I am picking up a few more shares in Boohoo. So Boohoo had a really bumpy 2020. As you can see, there was a lot of dips in the stock price, and it came a bit of a swing trader stock. And myself really, I was kind of buying it a couple of times in these dips, and when it went up I was selling a bit of shares. So even me as a long-term holder, I have been buying and selling a little bit in these dips, and still hoping to keep some shares for long term. And when it got to about 2021, we had a really good run into 2021, and it was kind of like, okay, the worst is behind us now. Boohoo isn't, a lot of these dips were caused by negativity in headlines, and you think that's the worst of it past now. Going into 2021, I think it's going to be quite a good year for Boohoo, but it's been totally opposite so far for them in 2021. You'll see the share price is down 46% since we entered this year, basically. Massive sell-off, and you know, we're talking a £3.62 nearly, all the way down to £1.84. So you're thinking right now in the course of 2021 there'll be a massive problem with this company, and that's why it's sold off, and that's what we're going to get onto why I'm buying, because in my opinion, sure, there's a little bit of bad news out there, but to lose half of your company's valuation, I just think it's absolutely bonkers. So if you don't know Boohoo, then they do offer a lot of clothing, a lot more fast fashion. They do have a lot of different brands though. It isn't just the Boohoo and Boohoo Man brand. They do have other brands like Pretty Little Thing. They've recently acquired Debenhams, which isn't really, it was a massive purchase as well last year, and it's not really been shown too much in the financials yet. They've only just recently bought it, and they've just got the site back online recently, and they're still kind of putting that all together again, and that also adds another beauty side to it. And also, what Boohoo has been quite often is that 18 to maybe 23 age range, but now what it's going to do with these sort of brands, it's now going to be Boohoo's now going to have the umbrella for 18-year-olds all the way up to, you know, 80 years old or plus. You know, it's going to have that sort of age range now, which is, I think, is an absolute great acquisition by Boohoo. Now, if you look at what's going on with the share price recently this year, you can see that it actually wasn't too bad of a year when we got around to like February time, and then really since April time, there's been a massive fall off in the share price. That's really where the peak of the share price has fallen off. And the reason why is because, first of all, you've had a bit of lockdown easing. So you've had people more going to the high street rather than going online. And that's had investors rotating back into retail stocks. Fair enough. And then when we got around to about June time, ASOS was starting to post in weak earnings, and people were thinking, is this going to happen to Boohoo? And then especially the last kind of month, this big drop here is because of an earnings date. So there's a couple of things that have added up to this fall off in share price. For me personally, I look at them and go, does that deserve a company to lose half its value? No. And I think that's what has happened, an overreaction here. Now, if you do go into earnings, you can see here revenue was up to 975 million, increase of 20% over a 2-year period, because obviously 2020 had so much demand pulled forward. It's up 73%, which is really good. You can see the gross profit is moving in the right direction as well. But the only little dip here was that profitability, or adjusted EBITDA, was a little bit lower in the second half of the year. The reason why, there was a number of headwinds driven by short-term factors, and one of those big things was higher shipping costs. So because of these short-term costs, it has meant the profitability on Boohoo has dropped down slightly. Now these are, remember, short-term problems. These are problems that are going to last somewhere between six months to 12 months. So you look at this here and I'm thinking, okay, this share price here, does this deserve to lose half its value because of short-term problems with shipping costs that hurt the profitability a little bit? In my opinion, it doesn't. I think these short-term shipping costs are going to sort themselves out, or what's going to happen is prices will just increase a little bit on Boohoo to cover the cost of that. And for me, I look at something like this and think, this is just a complete overreaction. So you're giving me what in a second I'll show you, one of the best growth companies on the UK stock market on a 50% share price drop because of short-term factors. And I think that's absolutely bonkers, and that's why I'm building it up, and I'm really confident to make it a big position. If you look here at the historic performance of this company, look at the performance here. The revenue has just gone up and up and up and up and up, and as well as that, the profit has moved in the right direction as well. Obviously a company like this, because it grows revenue so much, a really good revenue growth company, you know, this company is going to be growing 30% year after year. Massive revenue growth. We don't have many of them in the UK, and it is growing that profit at a really good rate as well. And it's going to have a little bit of a dip off, but once again, it's going to come back, and then what's going to happen is that revenue is still going to grow, the profit's going to come back, and it's going to go moving in the right direction. This company has a history of delivering, and you look at that performance there, really good. And you can see on the analyst expectations here, you can see the revenue growth is still forecast to carry on, and I think they'll still forecast to carry on. And you can see there's going to be that little dip in them earnings, and then it's going to come back again, and that's what I think is going to happen. As well as that, you have an amazing balance sheet here, and the debt to equity is really low. Even after the massive buyouts they've been doing, they're still very good on cash, 148 million in cash, and they've been buying massive brands recently as well. So the balance sheet is really healthy on this company. So overall, in my opinion, I look at this company and think it's lost half its value, and in my opinion, this company is short. There's a few short-term problems, but this is an amazing growth company that will see a lot of these problems disappear in the next coming 6 to 12 months. And I think that to get this company on half the value of what it was, with only a couple of short-term problems, you'd think there's a major problems inside the company. You know, you think there'd be forecasting negative sales or something. I'm happy to pick shares up in Boohoo at these sort of prices. So number one is Boohoo. Number two is another company that has been really hurt by logistic problems recently in the last quarter, and that's caused a little bit more of a dip on the share price. But still, in the long term, I still think this is going to be a great company, and it is Corsair. So Corsair is currently at $24. You'll see here that it had initial spike up after IPO. Caught my interest, but I just went, it's a bit too much of a high valuation. And then since February time, it has, as a lot of small market caps, has had a bit of a pullback. So when it had this pullback since February, and I just saw it getting lower and lower, around when it got to about April time, I thought, you know what, I'm going to have to start picking some of these shares up in this company. And I've had to average down a little bit. I don't mind doing that one, but right now at $24, I do really like Corsair. The reason why it has been downtrending since its IPO is probably because IPO is probably a little bit overvalued. I would say Corsair at 44 is a little bit of a high valuation, not crazy, but a little bit of a high valuation. But classic, what normally happens after IPOs is they do sometimes have a bit of a sell-off. And what has happened as well is a bit of a big insider, so one of the biggest shareholders, or the biggest shareholder, is selling a few shares off at the moment. That spooked investors a little bit, and that's probably added to the downtrend here. But I'm not too bothered about what that means for Corsair as a company in the long term. Now at the moment, it's a 2.3 billion market cap company. It is currently trading at a 15p ratio, which I really like. And if we go onto the website here, you can see they do a lot of things to do with streaming, gaming. I think that's a massive growth sector. Gaming gear, streaming gear, PC components, gaming parts, software. And you'll see here, this is one of the new products. They add so many products very quickly, and this is one of the new ones, the new gaming monitor as well, which looks very impressive for the first monitor. So that's a new income stream they're going to have, and I think gaming, streaming, just going to massive growth over the next few years. People say it's only just a CV boom. I disagree. I think it's a massive, huge growth sector for the next couple of years. Has been for the last 5 years, will be for the next 5 years as well. And like I said, a lot of these problems come from the recent preliminary earnings are actually reporting on Tuesday or tomorrow. They're full earnings, but the recent Q3, they kind of gave a soft guidance as they said that logistics were going to cause a bit of a problem. Once again, logistics, I think this is a bit of a short-term thing, 6 to 12 months. And for me, Corsair, I think it's already at a crazy valuation, and now it's going even lower. I'm just happy to buy more shares, really, because I think it's a great company. Going on to what they've done previously, you can see they have a history of doing very well. Down here, they've got 511 million. If we go to 2020, they have shot their revenue up to 1 billion. And especially last year, the growth that they've had has been really good. And the thing as well is now is they're making really good amounts of profit. The profit margins have gone up quite a lot. And what analysts don't really realize, and simple Wall Street analysts aren't too bad on this, but the company is still going to grow around about double-digit revenue growth. It's going to have about at least 10% plus revenue growth, and that's also going to mean good profit growth. So when I go back to this here, then I was talking about Corsair as being a 15p ratio. For me, a company that is one of the market leaders with a great reputation that's going to grow at double-digit revenue growth doesn't trade down at these sort of valuations, and that's why I'm happy to carry on picking some shares up in this one. And the last one is Planet 13. So this is an MJ play. That's a bit of a code name if you know what I'm talking about. And a lot of the MJ stocks have been really suffering. Now the reason why Planet 13 is down so much is there actually isn't a reason. There's no reason why Planet 13 is actually really down as much as it is. It's just been caught up, I guess, with a lot of other stocks coming down in that sort of sector. And I'd like to say there's a reason why it's fallen off a cliff. These Boohoo has had a bit of logistic problems. Corsair's had a couple of logistic problems. Planet 13, the last earnings were absolutely phenomenal. They just grew revenue at 200% revenue rate. And yeah, for me, I'm just kind of don't want to buy too much because it is still a spec position for me because of the industry that it's in. But I am still starting to pick up a few more shares, especially down at these sort of valuations. So Planet 13 is now down at $3 or $3.85, and you can see here that it was originally around $6 only June, and since then the company's nearly lost half its value. And like I said, you'd think massive problem here with Planet 13, but there isn't. I cannot find really a massive reason to justify the massive drop off for this company. Now this is what they do. They have two big locations, and they sell these products in these locations. This is one of them here. This is the Las Vegas location. The stores look absolutely amazing. They sell some of their own products as well as selling other products. But the thing is these stores look absolutely phenomenal, and people come to these stores not because of the products, which is good that they have their own products now and they have a bit of a brand awareness building up, but because of the experience as well, and that's why I like it. It's not battling away on pricing. People come here for the experience. It's like the Hollywood Bowl of MJ, I guess. And the great thing about this is that people love the location so much. They've always posted on Instagram about it, showing off on Instagram. And even look at TripAdvisor, the reviews are really good. It's got Traveller Choice Awards 2021. And I think the more they add some of these locations, if they can get to 5 locations by 2025, I think we're going to be very happy as shareholders. Now looking at the company, you can see here, back in 2018, 2019, it wasn't doing too much, but what has happened is the ramp up in revenue has been absolutely amazing. 2020 was a bit of a write-off year, even though it still did okay. The reason why obviously is that you had travel shut down, and that obviously affected them. So 2022 was a bit of a write-off year, even though they made a lot of good improvements in the infrastructure. But what is happening now, when we get to 2021, they're smashing it out of the park. So you'll see here 70 million, and you'll see here that they're looking at maybe doing 131 million this year. And there's a potential they could get to profitability. They don't really lose too much money nowadays, so that's going to be great. And then going on to next year as well, 2021, go from 131 million to 192 million. So that's going to be a massive increase. We're going to go from 60 million to nearly 200 million in 2 years. So that's great. And you think about the more locations that are open, they're not going to lose much money either, because they're actually quite a profitable business already. I really love it. This is my play in an area that I think is going to be really big in the next few years. And the thing as well is they're quite healthy as well. They're valued around about 749 million in Canadian dollars, and you can see here they've got 163 million in cash as well. So the plans to expand as well isn't going to need much money raising, because they've already got a lot, which is great. So yeah, with Planet 13, I mean, I don't know why the stock's falling down so much. I'm not complaining, because I always wanted to have this stock in like an average of $3 or $4. So I wouldn't mind picking in some shares up, but for the reason why it's fallen off so much, I don't know really, because the company's delivering absolutely huge as what I've just shown you in the financial side of it. So yeah, as long as I can pick up some more Planet 13, and like I said, my aim with this one is that it's a massive growth sector. They open more stores in the next few years. The revenue goes very well. They're going to start dragging in a bit of profit as well. So yeah, my play in a very big growth area, I feel, in the next few years. So yeah, that's number 3. So I hope the video was useful. As always, if it was, hit the like button. If you're new, subscribe. If you want to, put it down in the comment section what you've been buying. I always love going through the stocks that you guys put in the comment section. Sometimes there's a few stocks that I haven't heard of and I can research them as well. I'll do a quick look and maybe add it to a watch list. So yeah, thanks so much for watching, and I'll see you on the next video.